Good afternoon and welcome to the BBBA Tax and Regulatory Update. I suggest we go ahead and get started. We still have some people logging in, but time is valuable for all of you. So without further ado, I suggest we start today. My name is Miroslava Alexandrova and I'm the Executive Director of the British Bulgarian Business Association. The purpose of the Tax and Regulatory Update is to give you a short overview of what is new in the legislation that is important for you to prepare in your business. So this year we decided to split the topics in 2 consecutive days. Day one today is dedicated to legislation in Bulgarian. Tomorrow you will be able to hear about Brexit updates in the regulatory world. Without further ado, I would like to thank all our annual sponsors, without whom those type of events wouldn't be possible to have free access for all of our members and partners. Big thank you to Deloitte, Athlon, Cleves, Landmark, Bulgarian Insurers, and Novotel Hotel Sofia for your loyal support. And a quick overview of the rules that we will be following today, webinar basics. Note that the chat is disabled for all attendees. If you would like to ask a question, please use the Q&A button at the bottom of your screen. You can ask questions after each of the presentations. There will be 5 minutes dedicated to Q&A after all presentations today. If there are too many questions and we are short of time, our speakers have promised that they will be able to respond to your questions in writing further on. Note that the webinar is recorded, so you will be able to have access to it following the webinar as well. Now I would like to give the floor to our chair, Miroslava Alexandrova, for a welcome note. Mira, the floor is yours.
Thank you very much, Desi. Dear speakers, dear fellow members, I'm very happy to welcome you to the first online version of the otherwise 4th Annual Tax and Regulatory Update. Last year, we faced a lot of challenges. We discovered the new normal, the digital reality through Zoom meetings, webinars, and online after hours. We rediscovered the home office and the online shopping. Companies remodeled their business, trying to turn every challenge into an opportunity and to stay competitive. Right before Christmas, the EU-UK Trade and Cooperation Agreement was announced. In these dynamic times, it's ever more important to keep up to date and with the global changes, to be following all legal requirements, as well as to promptly prepare for the upcoming ones. Today, we will learn about the changes in the social security and personal income taxation, about the VAT changes in online trade, and will be introduced to the legal basics of the crypto assets. Tomorrow, as Desi already mentioned, we will focus on some practical aspects of the post-Brexit economy: people movement, protection of trademarks, cross-border dispute resolution, and we'll discuss, of course, the impact on Brexit on innovation, technology, and outsourcing. Finally, I would like to express our gratitude to our speakers for sharing their knowledge with us. Enjoy the webinar. I hope you will find it useful. Thank you, Desi.
Thank you very much, Mira, for your welcome note. I have to confirm that we are very lucky at BBBA that we have so many knowledgeable speakers that we can rely on for their expert advice. And today's webinar is such an example. Our first speaker, actually 2 speakers from EY, will be talking about social security and personal income taxation, an issue that is very important for all business leaders. Thank you very much to Milena Blagoeva and Nevena Kovacheva for agreeing to share their expertise in this respect. I would like to invite you to start. Milena and Nevena, the floor is yours.
Thank you, Desi. Good afternoon, everybody. My name is Milena Bagova, and I'm an associate partner in the tax practice of EY, responsible for payroll, accounting, tax compliance, and statutory reporting services. Today, together with my colleagues Nevena Kovacheva, I will present to you some important aspects of social security and personal income taxation for this year. I will start with the Social Security income and Social Security contribution. Next slide, please. Effective 1st of January this year, the minimum working salary and monthly Social Security income increased from 610 to 650 level. The maximum monthly Social Security income remains 3,000 level. This results in an increase in the health insurance burden for the employers whose employees use unpaid leave due to COVID-19 crisis. Health insurance contributions for persons on unpaid leave are bound to the Social Security income of the self-insured persons and are entirely at the expense of the employer when the unpaid leave is due to work suspension. Next slide. The Social Security and health insurance burden for this year is approximately 33%. The split of the Social Security burden between the employer and the employee remains the same as it was last year. Contributions to the guaranteed receivables of the workers and the employees fund will not be due this year. Next slide. There are no significant changes in the regulation concerning monetary benefits paid by the state Social Security. The benefits for the first 3 days from the temporary work disability will continue to be at the expense of the insurers and will be calculated as 70% from the average daily gross remuneration for the month in which the disability has occurred. The child care benefit for raising a child aged 1 to 2 years remains 380 level per month. This year, the daily minimum amount of unemployment benefits will be 12 level. The daily maximum amount remains unchanged at 74 level. The amount of the one-off benefit in case of death of an insured person will be 540 level. Next slide. There are some important changes in the labor legislation which need to be considered by the companies. From this year onwards, the additional remuneration for night work will be tied to the minimum working salary and become 0.15% of it for each night hour work or for part of it. The purpose of this amendment is to ensure that the additional remuneration for night work increases with the increase of the minimum working salary. There are important changes in the regulation of accumulated working time. This is a form of flexible working time, allowing the employer to calculate the working time of the employees for a longer predefined period according to the business needs. The period for which the employer could establish accumulated calculation of the working time effective from 1st of January this year is amended from 1 to 4 months. Until 2020, employers were allowed to introduce accumulated working time of up to 6 months. A 12-month accumulated working time period could be established with a collective labor agreement. The branches and interstates for which a 12-month accumulated working time period could be established will be determined with an ordinance of the Council of Ministers. These changes aim to guarantee balance in the interest of the parties in the employment relation and to ensure a smooth working process and payroll reporting. Unfortunately, there are not transitional provisions related to these changes yet. The transitional provisions have to clarify how to proceed in cases where the 6-month accumulated working time period started, for example, in December 2020. We expect additional clarifications to be issued shortly. Another important change is related to the use of paid leave by the employees starting work for the first time. These employees could use paid leave after acquiring 4-month life of service. Up to this year, employees starting work for the first time were allowed to use their paid leave after acquiring 8-month life of service. Next slide. Unpaid leave at the initiative of the employee of up to 60 working days used in 2021 will be considered as work experience. The use unpaid leave of up to 60 working days will be considered also as insurance length of service, as it was in 2020. There is an important amendment in the Social Security Code introducing a term for interrupting benefits payment for temporary work disability, accident at work, pregnancy and childbirth, and raising a child up to 2 years of age when there is a need for inspection by the competent authority regarding circumstances relevant to the right or amount of the benefit. The payment could be interrupted of up to the end of the inspection, but not more than 6 months. Next slide. On the next slide, I present a summary of the most important deadlines for employers and insurers related to annual reporting obligations. There are no changes in these deadlines as a result of the state of emergency. Therefore, ensuring compliance with these deadlines requires planning and preliminary work related to obtaining the required documents and information, as well as updating of the payroll software used for preparing the reports. As you may see, 31st of January this year is the deadline for reporting of overtime work for 2020 to the General Labor Inspectorate. In addition, by 31st of January, the employers have to provide written notification to employees on the paid annual leave they are entitled to use in the calendar year, including carried forward or unused paid leave from prior calendar years. Next slide. On this slide, I have marked some of the main challenges many employers face as a result of the distant work. In the new normal, when work in fact could be performed anytime and anywhere, it is critical for the employers to introduce a process for reporting the working time by the employees. This involves investment in automated reporting tools, changes in the internal processes, and training and motivating employees to effectively engage in such reporting. One of the main goals of this process would be to carry out effective control when the work is performed during the agreed working hours, after them, during the weekend or a public holiday. In the absence of an effective reporting process, there is a risk of night and overtime work or work during public holidays, which could not be identified and paid in accordance with the legal requirements. Until the beginning of this year, the introduction of flexible working time models was rather an opportunity for most business sectors. However, with the transformation of the way we work after the beginning of the pandemic, this became a necessity. The change from standard to flexible working hours requires a careful analysis of the legal requirements covering all aspects, labor law, payroll, tax, and social security to ensure compliance with the Bulgarian legislation. Distant work has also created significant challenges in reporting employees' absences. In practice, most employees do not need to use paid annual leave, as they could work anytime and anywhere. This will result in higher salary costs related to accrual of provision for unused paid annual leave for 2020. To overcome this challenge, employers have launched initiatives to encourage employees to use their paid leave. Part of these initiatives include introduction of internal rules for use of paid leave. Many companies have taken advantage of the opportunity provided by law also to force their employees to use their accumulated unused paid leave from prior years. Distant work also created additional costs for the employers, for the required equipment for employees working from home, as well as providing consumables and maintenance of the equipment. There is a tendency to include additional incentives in the employees' monthly salaries in order to cover the costs of high-speed internet. Although these are tax-deductible expenses, as employers are required by law to provide the equipment needed to perform distant work, an additional tax burden may arise for companies, as this equipment is usually used for both business and personal use. Accordingly, the personal use of company assets is subject to taxation. In conclusion, I would like to sum up that working at any time and from anywhere is associated with certain risks for companies, and we recommend careful analysis of all aspects and requirements of the legislation, payroll, HR, tax, social security, and labor law aspects is in order to cover and address the risk that companies face in connection with the work transformation during the pandemic. Now I give the floor to Nevena. Nevena, over to you.
Thank you, Milena. Good afternoon, everybody. I'm Nevena Kovacheva, Tax Associate Partner leading EY Global Mobility Practice. Let me start with the personal income tax changes introduced as of this year. Next slide, please. From a personal income tax perspective, no major changes are introduced. The personal income tax rate remains 10% flat. The cap on the monthly income, which is subject to Social Security contributions, also remains 3,000 leva. A main change is to be observed in the tax relief for children under the age of 18 years, which will be applicable for income earned this year. The tax relief is significantly increased. The annual taxable base can be decreased by 4,500 leva for one child, 9,000 leva for two children, and 13,500 leva for three children. Unfortunately, this change may apply only for this year, as it is part of the State Budget Act. In addition, a new tax relief for repairment work on property is now available, and the annual taxable base can be decreased with up to 2,000 leva. The scope of non-taxable income has also been slightly extended. Upon the initiative of the Bulgarian Stock Exchange, a market for growing companies was created, which aims to support small and medium enterprises. Interest income or transactions with financial instruments traded on this market will be non-taxable. As there is currently only one company registered in this market, and due to the low interest in it, I do not expect many individuals to benefit from this change. With regard to the Tax and Social Security Procedural Code, a change has been adopted which allows overpaid amounts indicated in submitted tax returns to be used for future payments. Next slide, please. Let us go briefly through the tax return filing deadlines. As you may recall, the law on the measures during the state of emergency has extended the deadline for tax return filing in 2020 from 30th April to 30th June, while the early filing discount could be used until 31st of May. This extension was available only to traders, sole traders, and agricultural producers. With the last adopted changes, the deadline for tax return filing for these individuals is definitely moved to 30th June. However, the early filing discount is available only until 31st of March. For the rest of the individuals who have tax return filing obligation, the deadline remains the same as usual, 30th April. Next slide, please. The last year was incredibly challenging for all organizations. We have run a survey amongst our clients and partners as to understand which aspects of the new working reality were the most difficult for them. We are using this opportunity to share with you the results. Not surprisingly, the major part of our clients and partners, for them, the most challenging aspect is keeping work-life balance. Organizations also struggle with how to change and adapt their management style in the remote working environment. Other challenging aspects are flexibility and mobility, technology and digitalization, as well as the administration of adapted business processes. Next slide, please. What are the trends in global mobility? The global workplace has been undergoing change for many years. While labor centralization has been the traditional model for centuries, with employees working together in one location, advances in technology have increasingly enabled remote working at locations away from the physical workplace. Then in early 2020, COVID-19 spread around and created a new dynamic in the working world. The pandemic actually acted as a catalyst for a shift from working in offices to working from home. While this proved difficult for many businesses and individuals in the beginning, organizations adapted at unprecedented speed to the rise to this change. While many of the potential changes related to flexible working arrangements that give possibility to work anytime, anywhere are largely positive, and for sure employers have now a broadened pool of talent, we need to take into account a whole set of implications for businesses around this new normal. We have a growing amount of short-term travels replacing the traditional long-term travels and relocations we are used to. We have employees going back to work from their country of residency and not from their usual country of work. We have new types of employees called so-called digital nomads who work outside the office in countries where they wish to go. All these business travelers and employees who spend time in multiple countries lead to new multi-country immigration, tax, social security, and labor law compliance that needs to be carefully observed. Additionally, revenue generating and value creating activities may subject companies' profits to corporate taxation in a different country and may create issues around permanent establishment. We cover all these issues in our EY HR Academy. Next slide, please. Traditionally, at the end of each year, we are collecting information from our colleagues in the countries in our region in relation to expected tax and social security changes. Naturally, most of the countries expect changes and adopted already changes related to regulation of homework, distant work as a result of the new work models. Slight decrease in the tax and social security costs can be observed in some of the countries, like for example, Hungary and Croatia. However, as you may see from the graphics, Bulgaria still remains one of the countries with the lowest cost for the employer. We based our calculation on a net salary of €1,000, which simply means that the employer burden for salaries and social security in Bulgaria itself does not have the decision-making impact on the investment decisions. Last slide, please. Let me finish with what are the next steps, what are the next tasks and important areas for employers. Of course, first come the annual reconciliation for employees, as well as tax return filing, processes which require, of course, advanced planning. Next long-term task for all employers is to develop and adapt their internal policies so that they adequately reflect the new reality. In terms of business trips, employers should also review their policies for compliance with the Posting of Workers Directive and its third amendment, which is already adopted in our legislation, and very recent changes were introduced actually last week in the ordinaries for the business trips abroad. In a nutshell, according to the new texts, the maximum posting period is 18 months, whereby the initial posting should last up to 12 months with an option for an extension up to 6 months. If the posting continues after the end of this period, the labor law of the host country will apply in full to the posted worker, with the sole exception of rules on termination and occupational pension schemes. All mandatory elements of remuneration as per host country legislation shall be considered when determining the remuneration package of the assignee instead of the previously applicable minimum rates of pay. In any case, we strongly recommend that companies review and update their policies and practices on posting of workers to avoid unplanned expenses and group exposure to penalties in foreign jurisdictions. Thank you very much.
Thank you very much, Nevena and Milena, for covering these very important topics in such a short time. The purpose is not to respond to all questions, but really to raise questions and to give the idea to the employers what sort of changes there are, so they can talk to you later about those as well in more detail. Currently, I see one question in the Q&A section. I would encourage all our attendees, if you have any questions to Nevena and Milena, please use the Q&A function to ask them while they respond to the one question we currently have, which is, should the employer bear the employees' costs of internet and electricity related to remote work, home office? Who would like to take the question, Nevena or Milena?
For the equipment, it is clear that the employer should cover the cost. For the electricity and the internet, it is subject to it not be answered so clear. We may respond to you over email.
Okay, the person who asked the question didn't leave his or her details, so please, if you are willing to talk to Nevena and Milena, you can contact them directly or just write to BBBA and we'll put you in contact with them so you can discuss in more detail. I don't see any more questions in the Q&A session, so at this stage I would like to thank you both ladies for your presentation, which was very interesting and detailed. And of course, all of you in the audience, if you want to follow up with questions, let us know and we'll be happy to put you in contact with our speakers. Without further ado, I would like to move to the next presentation in our webinar today, which will be delivered by Vladislav Ganjiev from PwC. And the topic he will cover is VAT changes in online trade expected from 1st of July this year. Vladislav, the floor is yours.
Hello, everyone. My name is Vladislav, and I'm a senior manager in the PwC tax team. I would like to give a few words today on the changes in value-added tax area in the online trade. As it was very well explained in the beginning, the online trade is one of the new normal things that we rediscovered during the pandemics. The changes were actually planned to start in the beginning of 2021, but due to the COVID situation, they were extended. The initial moment of the changes was extended to 1st of July 2021. Basically, the general concept of these changes is that with the development of the technologies, practically there should be a chance given to the online traders to simplify their compliance by offering a one-stop shop reporting. What would this mean? This would basically mean that if one trader established in one country in the European Union is trading to customers in all other countries in the European Union, or at least several other countries, this trader will be able to do his value-added tax reporting in his home country, which means that he will not be required to register and comply with the rules in every separate country where he has clients, which is currently the situation. So this is seen as a major simplification for the online traders. The other aims of the change is to take measures against non-taxation of shipments from third countries. Currently, what is happening, or at least what is observed by the European Commission, is that in many cases the shipments of goods from third countries are declared as shipments of small value, and there's some kind of not taxed upon importation, and this creates a kind of unfair competition for the local European traders. So the new measures, the changes, they actually are trying to put on common grounds both the European traders and the non-European traders who trade on the European market. And one of the last big aims of this change is that stronger control should be given on the sales via independent online platforms. Every one of us can quickly, come to his mind that there are some very popular online platforms that actually give the option of independent small traders to trade their goods. And the European Commission has observed that this also gives the opportunity for the small traders not to pay VAT all the time. So this would be a change that is also that is also focused on anti-avoidance. Next slide, please. So basically, there are several new schemes for distance sales that are introduced. Basically, distance sales, these are the sales of goods that are sold by a trader in one country of the European Union to customers and customers. This is final consumers, not businesses, in other member states. So this was the concept of distance sales until now. Until now, distance sales was the sales from one member state to another. From now on, there will be three types of distance sales. First type is the intra-community distance sales. This is the distance sales that we know until now. This is the distance sales of goods that are moving from one member state to another. The second type is internal distance sales. This is distance sales of goods that will be moved within the same country. For example, a Bulgarian trader, online trader, or similar is trading over the internet with goods that will be purchased by Bulgarian customers. And the goods will not be moving from another country. They will move from one location in Bulgaria to another location in Bulgaria. And the last one is distance sales of goods imported from third countries. So this is something quite new, and there is quite some focus on this because we all know that there are many traders, for example, on the Asian market that are penetrating and trading on the EU market. So basically, these will be sales of goods that are dispatched from outside the European Union directly to customers in the European Union, which means that there will be an import process in this whole exercise. The place of supply, which is actually the place of taxation of this trade, will be the country in which the goods arrive for the customer. The place of supply, however, in case for some very small traders who have distance sales below 10,000 euros per year, can still remain in the country where the supplier is established. So basically, these three areas of distance sales will be the focus of the new regimes that are introduced from the 1st of July and would be very important for the compliance of these traders. Next slide, please. Another thing, as we mentioned, is very important in the changes is that there are new rules for the supplies of goods facilitated by an electronic interface. So basically, the electronic interfaces are independent platforms that are not owned by the sellers of the goods. They just give the opportunity to the traders to offer their goods to customers. And practically, what happens under the observations of the European Commission is that there are too many small traders trading on such platforms. And while the platforms is quite public for the authorities, the traders that are trading through these platforms are not so easily reachable by controlling authorities. And there are many cases where some traders are actually avoiding taxation by selling through such platforms. So part of the new rules that will be introduced from 1st of July will be that there is a definition of supplies of goods facilitated by electronic interface. And these will be intra-community distance sales of goods by taxable persons who are not established in the European Union, distance sales of goods imported from third countries where the supplier could be a person established in or outside the European Union, and also internal distance sales of goods by a taxable person not established in the European Union. So what is common in these 3 bullets is actually that either the supplier or the goods are coming from outside the European Union. So for the moment, this is the concept that there will be stronger control on these transactions when they have some element that is from outside the European Union. When there is such a transaction, what is expected to happen actually? What will happen is that there will be 2 supplies. So one supply from the trader to the platform and another supply from the platform to the end customer. What is the purpose of this actually? Even if the tax authorities are not able to find the trader and to ask him to pay tax, they will be able to find the platform and ask the platform to pay the tax. Also, this will somehow limit the small traders who are sometimes splitting their business in several companies, trying to avoid the VAT registration and not taxing this trade. So from the 1st of July, even if some trader is splitting his business in several parts, if he's trading through such a platform, of course, in these 3 situations above, the platform will be paying VAT to the state budget, which means that this trade will be actually put on common grounds, on equal grounds with the other big traders, and will be paying VAT on equal grounds with the other traders. The taxable event in such a trade will be the moment of payment. This is actually common for all the distance sales. So because this is a new type of controlled transactions, that is why there is a new special rule. Next slide, please. There are 2 new terms that are introduced in the VAT legislation in order to simplify the addressing of the countries in the European Union that are involved in this trade. First term is the member state of identification. This is the member state in which the supplier is registered for one of the new special schemes. And the other one is the member state of consumption. This is the member state in which the goods are delivered to the customer. Next slide, please. So there are actually 3 new schemes that will be introduced from the 1st of July that will be aimed to facilitate the trade within the European Union. So first one is the non-union scheme, the second one is the union scheme, and the third one is the scheme for distance sales of goods imported from third countries. The non-union scheme is actually from our practice of quite limited importance, but still we will mention it for the sake of completeness. Actually, this is a situation where the customer is a non-taxable person in the European Union, the supplier is outside the European Union, and the subject of the transaction is supplies of services. Until now, there was such a regime for supplies of electronic services, telecommunication services, and television and radio broadcasting services. From now on, this regime will expand to all types of services supplied to end customers. Next slide, please. So the most, the regime that is expected to have the biggest impact from the changes is the union scheme. This will actually be a regime where the customer, again, is a non-taxable person in the European Union. The supplier would be a trader established in the European Union for supplies of services to non-taxable persons. The supplier could also be a trader who is established or not established in the European Union for intra-community distance sales of goods or for internal distance sales of goods. The subject of the transactions will be supplies of services by non-EU suppliers to customers in another member state, internal or intra-community supplies of goods, including transactions through electronic interface, and intra-community distance sales. Next slide, please. So we can here give several examples because what I can say here is that actually the new changes introduced some very lengthy provisions in the legislation. The new changes are about 35 pages with very long descriptions of various situations. But we are trying to comment here only on the main main rules that should be remembered, and the exceptions they can be checked in the law, but the main rules are actually that these new schemes they will be optional. We will in a minute show what will happen if the option is not chosen. So basically, the first example here is for inter-community distance sales of goods. This is the distance sales that we know even today. The supplier in such a transaction will be selling goods, for example, from Bulgaria to customers in other EU member states. The supplier here has the right to register for application of the union scheme. And if the supplier registers for application of a union scheme, what will happen is that the supplier will be reporting all the sales towards customers in the European Union from its Bulgarian tax returns. And before the change, the rule required that the Bulgarian supplier doing such a trade should register for VAT in every country where he has a customer, which was quite demanding exercise in terms of compliance. The supplier had to find accountants and tax advisors in all countries to prepare and submit his tax returns. It is expected that after 1st of July, such a trader will be able to do all this reporting in Bulgaria if he chooses to apply the new regimes. If the trader chooses not to apply the new regimes, then he can continue the old way, to register in every European member state where he has customers and to submit tax returns in every such country, which is understandably quite more burdensome, and it is expected that there will be very small number of traders that will be choosing to continue the old way. Of course, this is an expectation. Time will show whether this will happen or not. Another example, next slide, please. Another example of such a trade we can see here is a supplier that is not established in the European Union. For example, a Chinese company dispatching goods from Bulgaria to a customer in another country in the European Union. Actually, the biggest developments, the big developments in international trade and in the electronic trade actually reached to situations where various persons could be trading with various goods starting from various countries. So here we have an example of a non-European trader who is trading goods from a location in the European Union. So these are goods that are shipped from Bulgaria, not from China, to a customer in another EU member state. Again, the Chinese supplier here has the right to register for the application of the union scheme. What we can add here as an example is that such a trader could also have some logistic warehouses in other European countries and could be trading from such logistic warehouses as well. But he will have the right to register in a single European country and do all the reporting from there, not from every country where he dispatches the goods, but from a single European country. So this is one of the biggest reliefs that are expected to be achieved with the changes. Next slide, please. And another example here is internal distance supplies of goods. So these are supplies of goods that are shipped from one location in Bulgaria to a customer in Bulgaria. So these are goods that are traveling only in Bulgaria. Again, the supplier could be a European company, a Bulgarian company, or a non-European company. Here again, we have given the example with a Chinese company. The supplier again has the right to register for application of the union scheme. So as we can see, there could be various combinations of the location of the supplier, location of the goods, location of the customer. So there are rules for all types of combinations, and this makes the changes to look that they are very big and in a very big volume, but in the end, the basic rules are quite simple. And this is that the trade within the European Union of goods that are starting in the European Union and finish in the European Union shall be reported in the union scheme, of course, if the suppliers choose to apply this relief. Next slide, please. Now we are moving to the third regime that will be introduced. This is the distance sales of goods imported from third countries. Basically, this scheme will apply for goods where the customer is a non-taxable person in the European Union, the supplier is established in or outside the European Union. The trade could be done through an electronic interface or directly from the website of the supplier. The subject of the goods are supplies of goods not exceeding 150 euros, and these goods are transported from third countries or territories. So, what is the difference here? The difference here is that the goods are not traveling within the European Union. The goods always come from outside the European Union, regardless whether the supplier is established in the European Union or not. And the important thing here is the monetary threshold that is introduced in the legislation. It is 150 euros. So basically, 150 euros, I mean, the full rule is that the shipment, so it could be several good pieces of goods in one shipment, should not exceed 150 euros. The specifics here is that import VAT will not be payable at the moment of import, but will be payable at the moment of transport. This is an option. This regime is an option for the supplier to register in the European Union. From the past experience of the European tax authorities, what actually happens with suppliers from third countries is that if they don't want to register in the European Union, the European tax authorities have limited power to seek for such taxable traders, and they have limited power to collect the tax from them. If they, for example, record the transaction as a small value transaction below 15 euros, which is exempt until today. And actually what happened till now is that in most cases, these transactions from traders outside the European Union were either reported as presents or they were reported as low value goods. And the importation of goods below 15 euros until now was free of VAT and import duties. And this made it very easy for such traders to avoid payment of VAT. What will happen after the change? The exemption of imports, as you can see in the last line, below 15 euros is revoked. This means that even a shipment for 1 euro will have to be subject to import formalities. And there are two options for such a trader: not to register in the European Union and have his customers, for every purchase they make, to go to the customs office and stay in a queue at the desk there to apply for import of what they purchased. And it is expected that in such a situation, normally the customers will choose European traders because they will not have to stand in the queue in the customs office. So that is why the European authorities believe that this will highly stimulate the non-European traders to register under this scheme in Bulgaria and pay the tax themselves, instead of asking their customers to go to the customs office and perform customs clearance procedures for every small shipment. Because normally, if I'm a customer and if I have to do to go for every purchase in the customs office to do some formalities, I will not choose such a supplier. It's a very normal explanation in such situation. Next slide, please. And here we have an example of this trade. So we have a supplier that is established outside the European Union, and the goods are traveling from outside the European Union to a customer who is a non-taxable person and consumer in the European Union. So this means that always we have import, and it is a question of choice whether the supplier will ask his customers to do the import themselves, or the supplier will register under this regime in Bulgaria and do the import himself and pay the VAT afterwards. Next slide, please. There is some separate arrangement here that is not part of these three arrangements that we discussed. It can be done optionally at the customs office. So this is a special arrangement for deferred payment of VAT on importation. If a supplier who is from outside the European Union, who is delivering goods from outside the European Union, is not willing to register under the regime that we previously explained in the European Union, he can hire a customs indirect representative and ask him to handle the process at the customs office for every import. Again, this special regime applies only for shipments of goods below 150 euros. It requires approval by the customs authorities upfront. It is applied, as we said, by indirect customs representatives. And this regime requires that monthly declaration is submitted to the customs agency by this indirect customs representative. So this regime has nothing to do with the tax authorities and the National Revenue Agency. It is handled only in the offices of the customs agency. The tax is collected from the final customers upon accepting the package and is remitted to the customs agency within 30 days from the end of the month in which the supply was made. Basically, here again, the most specific thing is that all this process is handled in the customs office. It has nothing to do with the tax authorities, and the foreign trader is not required to register in the tax office for the new regimes. All the process is handled at the customs office by an indirect customs representative. Again, all of the new regimes that we described, they are not mandatory, but they eliminate the requirement for the traders to register in many countries or to have their customers do the import customs clearance, which is quite a bureaucratic for a single consumer. Next slide, please. A few details about the compliance process. So the VAT returns under the new schemes will be submitted in the following way. So for the union and the non-union schemes, the tax period will be 3 months. The deadline for submission of the VAT return will be the last day of the month following the tax period. Even if it is a non-working day, the deadline will not be moved to the next working day. This is important to note. If there are no supplies during the period, a new return shall be submitted. So this is also important. Even if no supplies, there should be a new return. For the situation of distant sales of goods imported from third countries or territories, the tax period is 1 month. The deadline for submission is the last day of the month following the tax period. Again, even if it is a non-working day, this is the deadline. There will be no shift to the next working day. If there are no supplies, again, a new return is required to be submitted. The tax is paid within the deadline for submission of the VAT return. One important thing here to note is that even if the VAT reporting is done in a single country, I mean in a single European country, actually the supplier will need to issue invoices or receipts to his customers with the VAT rates based on the country in which the goods arrived. So if the supplier has customers in 27 European countries, then he will have to use 27 different tax VAT rates, and he will have to report this in this special VAT return. So this is not the standard VAT return that is submitted under these regimes. This is a separate, different kind of return that is only for this online trade. So although the supplier will not be required to go and submit tax returns in every country where he has a customer, the supplier will need to know very well the invoicing rules in the countries where the goods arrive. So this means that the supplier will need to set up his systems in a very informed and well designed manner, As we can see, the most important thing here in these procedures will be the good settlement of the good setting up of the IT systems. So the IT systems should know the VAT rates in every country and the invoicing rules for every country. Then the next thing that is important is that actually, in most cases, the taxable event is the payment. The receipt of the payment from the customer. So this means that the systems shall deliver information to the finance team of the supplier for the payments on each transaction received. So this means that there needs to be a very, very good setup again of the system so that they shall automatically produce all this information to allow the finance team to produce a decent VAT return. As we can imagine, a supplier that is having hundreds of thousands of sales cannot handle this process manually. Everything has to be done through well set up electronic systems. So the setup of the electronic systems, once again, will be very important for this process. Next slide, please. I think this is the last one. So here we have also mentioned that the persons registered for the special schemes will have to maintain separate special registers with data regarding every supply of goods or services. The registers must be kept at least 20 years, at least 10 years following the year in which the supply took place. So again, the setup of the IT systems becomes very important. So these electronic registers will be a little bit different from the registers that we're having now for VAT. These are how to say today we have these purchase ledgers and sales ledgers. While these ledgers will have different format, these ledgers will not be submitted to the tax office. They will be kept in the books of the supplier and shall be presented to the tax office in case of control procedures. So more or less, I think these are the most important things that we had to have chosen to present today. Of course, we will be happy to discuss any questions that you may have on the matter, and hope that we can be of help in this.
Thank you so much, Vladislav. You have been very comprehensive in your presentation. I don't see any questions in the Q&A section. Let's maybe give another few seconds to the participants. Now is the time to post your questions to Vladislav in the Q&A section.
Of course, if there are questions afterwards, we
yeah.
can, yeah.
Of course. So no questions at this stage. Thank you so much. I would say that your presentation was very comprehensive. Maybe that's why we don't have any questions. Let's move to the next presentation, which is the last one for today's session. I would like to invite Dimitar Kaldamukov from KDBM Law, who will talk about a whole different subject, crypto assets and their legal fundamentals. I'm looking forward to hearing from you. Dimitar, the floor is yours.
Desi, thanks a lot. Hello, everyone. So let's move to the crypto assets. We chose the topic for a number of reasons, actually. Reason number one is that 2021, in our opinion, is going to be a hell of a year for crypto. The reason is that the whole COVID stimulus in 2020 is not going to end, it's going to continue. And we already are seeing the results. We've seen inflating of number of assets, like you have real estate, you have art, you have financial instruments, of course, and crypto. So the logical conclusion is that more and more investors, more and more consumers, more and more businesses will be attracted to this type of market. Then the other reason is the new digital finance package which European Union is going to adopt. Part of this package is the first ever crypto regulation. This is symbolic, actually. It's a game changer. It's going to bring stability. It's going to bring legal certainty on the market. because without certainty you cannot have a certain trade. I mean, you can have a risky trade, but it's not going to be, investors will not going to be certain. So we're looking forward to the regulation. I'll give you a few insights about it later on in the presentation. Then the next reason about this topic is digital euro. That's so to say a stable coin. Just the other day, Christine Lagarde was saying that we're not there yet, but we're gonna be. It's not a matter of if, it's a matter of when. In this respect, Europe is kind of catching up with United States and China, Turkey. They have already proposed their digital sovereign currencies. So having a digital sovereign currency issued by the European Central Bank, this means that the central bank will be able to intervene directly with the market, which raises different set of questions. But in this way, a lot of issues will be solved faster. We've seen this in the current COVID crisis, where money was on the floor, but the private banks were kind of slow to redistribute it. So digital euro is one of the weapons that the central bank is going to have. And the last reason to put this presentation is the whole changing payment schemes that are around us. The payment setup that we're kind of feeding. The payment world is changing, and crypto is just part of it. So let's kick in. Let's start with two short videos. These are about two different crypto projects, but let's see them, and I'll continue afterwards. Can you turn on the video, please?
Remember when these were fast? And these? Technology has improved the world around us. So why is it simple to send one of these anywhere in an instant, but not money?
Bartering to shell to gold to money.
What if we made money truly global, stable, and secure? What if everyone was invited to the global economy with access to the same financial opportunities? Introducing Libra, a new global payment system designed for the digital world, backed by the belief that money should be fast for Ope in Lagos, simple for Saul's family business in Manila, and secure for Betsabe when sending money home to Mexico City. It's powered by blockchain, making it safe and accessible, no matter who you are or where you're from. So join us as we move towards a world where money works for everyone. This is Libra, and it's just the beginning.
All right, can we check out the next video? It's on the next slide, please. All right, cool. So I'm not sure if you did recognize these. So these are two crypto projects. The first one is Libra. It's a child of Facebook. They actually renamed it. It's already called GM. So the idea of Libra is that it's going to be a stable coin. It's going to be backed by a basket of currencies, fiat currencies, I mean, like USD, Euro, Swiss franc. And the whole thing with the Libra or GM is that every Facebook user should be able to send money wherever he wants to another Facebook user. If you think about this, it's huge. Actually, the EU crypto regulation that I'm going to speak about in a minute has been kind of instigated by this Facebook's project, because allowing Facebook to have a coin, to have money, to be able to issue money, means that Facebook is going to be the biggest central bank in the world. The other project, on the other hand, solves the same issue: how to, transfer money fast and cheap. The thing is that they do this in a decentralized way, while Libra is, centralized on the network of Facebook, governed by Facebook, controlled by Facebook. Strike is using the Bitcoin's Lightning Network. That's the second layer over the blockchain, where the transactions are not actually recorded into the blockchain. In the Lightning Network, you record only the opening and the closing transaction. So everything that comes in between is only registered with authentication, with signatures. And this, makes the Lightning Network really fast. It solves the inherent Bitcoin's problem of 7 transactions per second. So these guys from Strike, they want to use the Lightning Network and connect your Bitcoin wallet to your bank wallet and allow you to be able to send euro, transferring to Bitcoin via Lightning Network. And the other guy in the United States is going to receive USD. It's really interesting. And the whole idea of putting up these videos is that when you have a crypto asset, we're kind of thinking of it as a, this number on the crypto exchange that is going up or down. We're in the thinking box of, Bitcoin being $30,000, Ether being $1,000 or so. But the thing is that behind every asset, there is a kind of underlying, technology or idea or something, a product, which usually gives the value of the asset itself. And this allows us to assess legally and financially the asset itself. And the assets are actually 1,000. I mean, approximately 8,000 of them, of crypto assets, crypto projects. 99.9% is pure garbage. And I mean pure garbage. But the market cap is $1 trillion. And, you have the dominance of 63% of the Bitcoin. Can we have the next slide, please? So the European Commission was kind of slow, but they in the end of the day, they reached the idea that we have to define it. We have to have a legal certainty about what is a crypto asset, what is a crypto service provider. We have to regulate these things if we want to have legal certainty, and more important, if we want to have market. Because market comes with certainty. That's that's the way it has always been. So before the regulation, like next slide please, we've been always wondering whether a certain crypto asset, whether it's a financial instrument, whether it goes as a commodity, whether it's e-money, money, property, what is it? So in the past, we've seen memos, letters, warnings from European Bank Authority or ESMA, which is the governing body for the Securities Commission on a European level. So these two of the 3 biggest financial, public institutions in European Union have been warning about crypto markets. They've been explicitly saying that if we speak about Bitcoin, that Bitcoin is not a financial instrument. It's something different, but it's not a financial instrument. A lot of crypto assets are actually resemble financial instruments. A lot of them are e-money if we're looking at the current definitions of e-money, because like stablecoins are pure e-money. We've been warning our clients that they are for years, because every stablecoin is actually promising to be redeemed by the issuer. Can we have next slide, please? So with the issuing of the proposal of the crypto regulation, it's being put up in October, I guess, October 2020. The crypto regulation, I mean, it has to be adopted this year. So European legislators has finally provided a definition of what crypto assets are, which, as we can see, is kind of wide. I agree with it. It makes sense. It's digital representation, value of rights, which are stored electronically using distributed ledger technology. It's totally wide. Everything can goes into it, and that's the point of it, I guess. Can we go to the next slide, please? The whole idea of the new crypto regulation is that we must have certainty with respect to the crypto market. Can we go to the next slide, please? Excuse me. If you have ever been, so miserable in your life to have read the MiFID II regulations, which MiFID II regulations, for all the other happy people who haven't ever read them, MiFID II is the EU legislation which concerns financial instruments. It's thousands of pages. So what European regulators are trying to achieve with the EU regulation on markets and crypto assets is they're kind of copying it, the MiFID II. So we're gonna have full regulation, I would say, which is good again, in my opinion. We will have regulation for what the white paper should contain, what is the liability of the issuers of crypto assets. That's very important. We've seen for years, ICOs, for example, which went bust, which were pure lie for the consumers, but you can't do nothing. Probably we have agreed to some terms and conditions somewhere. Now with the crypto regulation, the liability is kind of provisioned. You're gonna have a capital requirement. So every crypto asset company, every company which kind of provides crypto asset services is going to have certain amount of capital as a minimum. Then you have to have a reserve of assets, custody requirements, and something very important, market abuse prevention, which kind of resembles the obviously on a lighter level, kind of resembles the MiFID II regulation. Something very important here. So the crypto asset regulation has been instigated, has been provoked by projects like the Facebook's Libra, by Tether, by the Gemini dollar. These are stable coins, and it turned out that it's not the crypto assets per se which are threatening the old-fashioned financial market. Is the stable coins that are doing this, because for example, you can imagine in the current situation where the interests on deposits are like zero or even negative, and at the same time you have interests on deposits and on stable crypto assets which go to 8.9, 9 point something on the Tether and on the USD, on the Gemini USD. It's crazy. We in Bulgaria have seen these interests in corporate commercial banks 7 years ago. We know what happened, but people are flooding their money into the stable coins. So that is why the crypto regulation that is going to be adopted is particularly focused on stable coins. They provide two separate definitions. You see them: asset reference token, which is going to be the GM, the Facebook's. If Facebook ever create their stablecoin, it's going to be an asset reference token. And it's not going to be only an asset reference token, it's going to be a significant asset reference token. And the regulation says that asset reference tokens are, tokens which are backed by a basket of assets. It can be gold, it can be fiat currency, whatever. On the other side, we have electronic money tokens, which are the pure money, crypto money, which people are using every day, like the USD Tether. They are electronic money tokens. Again, requirements for them. The funny thing is that the crypto regulation it's impossible. They cannot regulate Bitcoin, obviously, the king of the market. And the reason is very simple. It's decentralized. You don't have one single point of failure, as it is in comparison to the Ether, for example, where you have the Ethereum Foundation or whatever. So BTC as an asset, it's not, so to say, it's not regulated, but everyone who touches BTC, providing advising on crypto, including BTC, custody services or wherever, they will be regulated. Crypto markets participants. Can you go to the next slide, please? So the regulation provides for this this explicit list of crypto asset services. Basically, everything falls inside. What you have to take out from here, from my talk, is that if you kind of touch crypto anyhow, if you provide advices, if you provide custody, if you are a crypto exchange, you have to be sure that you get acquainted with the crypto regulation. It's here to stay. It's gonna kick in. And you have to have, as I said, the minimum capital, the custody, the rule for custody reserves, and so on and so on. And can we go to the final slide? The point is that the regulation is good. I mean, I know that most of the people in the crypto sphere are kind of, oh no, it's regulation is the end of the day, free lunch is over. No, actually, regulation brings stability. Big regulation brings big money. Actually, the lack of regulation was one of the reasons why crypto is still kind of perceived as something, hipster. But it's becoming mainstream, and chances are that sooner than later, you're gonna pay in crypto, you're gonna save in crypto, probably gonna launder money in crypto. I don't know. I don't care what you're gonna do, but it's coming. So thanks. If you have any questions, shoot them. If I can't answer now, you can, my email is on our website. You're welcome. Thanks for listening.
Thank you very much, Dimitar. This is a very nice ending of your presentation and today's webinar. I see a couple of questions in the Q&A section. One of us, the first one is actually directed to us as the organizers. Yes, we will be happy to share the recording and the presentations from today with all registered participants. So don't worry if you came in late or did not have a chance to watch until the end. You will have the recording. The second question is from Maria Lazova. I'm not sure whom it's directed to, but probably one of our speakers will recognize it, probably Vladislav. If goods arrive from China and are stored in Germany, but supplier e-platform is in Bulgaria, which EU law applies, German or Bulgarian? Anybody would like to respond? Maria, if you could write in the chat, which in the Q&A, which speaker is your question directed to, that would help. No, nobody recognizes. The first question is related to VAT implications. So Vladi, that should be for you. Vladislav, can you hear us?
Yes, of course. I mean, just typing the answer. Yeah.
You're typing. Yeah. I invite you to just say it out loud so everybody can hear.
Okay. So basically, when the goods arrive from China and are stored in Germany, but the supplier, the platform is in Bulgaria, which EU law applies, German or Bulgarian? So basically, it is how to say a little bit of question that requires a few more clarifications. But first thing is that if the goods are stored in Germany, then we have import of the goods to Germany, and then we have only European transactions. So if there are no additional facts, my understanding is that this is a transaction that will happen between the supplier and the customers in the European Union, only on the territory of the European Union. So the import is a separate transaction. And after that, then the supplier here has two options. So one of the options is to have the goods taxed under the old rules, meaning that the supplier can register in every country where he has customers, or after 1st of July, the supplier can use the new rules and register under the EU scheme and report this transaction in his VAT return under the EU scheme in the country where he chose to register, because the supplier can choose to register in one of the European countries, and there is no need to submit tax return in other European countries if he makes this choice. I hope this answers the question. If there are additional details, I would be happy to discuss separately.
Thank you very much, Vladislav, for your response. There is one more question, this time for Dimitar. New regulations are expected to regulate issuers and service providers. How about guarantees and protection for investors in crypto assets? Dimitar, that one is for you. If you could answer live, it will be great. So
I'm doing it live. Yeah, sure. So absolutely. Protections for consumers, for investors are also in the regulation itself. So that's actually part of the idea that investors should be protected. So it's there.
Okay, great. Let me see. I don't see any more questions in the Q&A. So I think we have covered everything so far. We have 3 topics today. Thank you very much to our speakers who shared their knowledge with you. I'm sure that there will be follow-up questions after the webinar as well, and you will have the recording and the presentation so you can share them with your colleagues or partners. Tomorrow, please join us again for at the same time for a session on legislation following Brexit. We will talk about people movement, trademarks, customs and VAT implications, as well as cross-border dispute resolution, all hot topics. Our speakers tomorrow will be from Deloitte, DGKV, Camburopan Partners, and New Balkans Law Office. So looking forward to welcoming our attendees tomorrow. Wait, I think one more question. It's just a thank you from Albena Stoyanova. Thank you to Albena. So thank you very much, everyone, for joining us today. As usual, the online format is attracting quite an extensive audience, and we're looking forward to seeing you tomorrow. Thank you again to our speakers and wish you all a very good evening. Bye-bye.